I'm Ashley Johnson with Simply DFW Realty Group, broker by TD Realty. I'm actually a new realtor, which many of y'all know, but I thought this class would be awesome for you guys because I think everyone has the same question. So do I. This is Jimmy and Felicia Foster with Geneva Financial, and they, oh my goodness, I think I learned something every time I talk to this woman. So I will let them take the lead. I'm going to make them the hostess with the mostest. And just remember, if you have any questions, just let me know.
Thank you, Ashley. We appreciate that. Y'all are too very kind when y'all introduce us, truly. we try to lend whatever knowledge that we can to as many people, that want to listen and that, just are open to it, really. So I am going to quickly put on to share my screen here. And so that way we can kind of get a little bit, kind of jump into it because it is a lot. And we are really going to try to do our best to get through as much as possible. As Ashley said, we are Jimmy and Felicia Foster. We are with Geneva Financial, and we have been in mortgage a long time. Jimmy has been in nearly 20 years.
Been that already?
Yeah, almost. Yeah. We're getting there, maybe in a couple more years, I think. And just has a lot of knowledge from really all avenues, all perspectives or spectrums of mortgage, from originations, of course, all the way to, unfortunately, foreclosure. So his knowledge is from pretty much the beginning to the end of, what could be that life cycle of a loan. Mine, almost 15 years of mortgage experience. I've done compliance, processing, quality assurance, but just really enjoy walking with our buyers, our borrowers, to get through this process. Just a little bit of personal. Jimmy and I have been married now for 25 years. In some capacity over those 25 years, we've probably worked together for about 18 or 19 years, I think. So we don't know why we do it. We just do. And it seems to work. We're still here. I still like him. He still likes me, most of the time. So, but this is what we love to help people become homeowners. And even if you don't become a homeowner, we just love to educate people about, what that can look like for them until they get to that point. So, Jimmy, you want to add anything before we jump in?
No, I think you covered everything. I'll jump in throughout the process. So as you guys can see, who's the talker out of the two of us?
Not really.
Guess it depends on what it is.
Yeah.
But, our passion is definitely helping people getting there. We're big on educating our clients, before and throughout the process. So they don't get all the way to getting handed keys to a house. And it's like, how in the heck I got here? What did I get into? What did I get? No, we want to make sure you understand everything that's going on and how you got there.
Right. Okay. So with that being said, we do have some of our information here. We are licensed in Texas and Louisiana. For those who may hear my little Louisiana twang come on out. So we do business in both states, all over the state of Texas, all over the state of Louisiana. Hopefully next year we'll be in a couple more states. We're just seeing how that'll go for us when licensing renewals come up in another month or so. So, and then we also have our contact information as well. Jimmy's email, my email, our office line, as well as our websites. Okay. So we will start the process just by talking about, the loan process. Well, not the loan process, but how do you get pre-approved, how that process begins. And honestly, I used to tell people it starts with an application. You just complete an application. And one day a little light went off and I said, you know what? It actually starts with, you have to make a decision first. You have to make a decision to become a homeowner. That's the first thing. and then you can complete an application. Usually that'll be with me over the phone if you call and you would like to do that. We still do hand applications, handwritten applications. We're not so new school that, we don't do that stuff anymore. And we also still, from time to time, we'll meet people because there are some people who just want to see you in person. They want to put a face with a name, and we're fine with that too. We have people come in and we do their application in person. Our office is located in Duncanville, which I did not put that on the first slide, but our office is located in Duncanville. We're right down the street from Duncanville High School. Or if you don't do online, over the phone or in person, then we also have the online application. So that you can do that in the convenience of your own home whenever you have time. Step 3, once we get your application, once again, it'll most times be me. I'll be looking at your credit, looking at some debt, looking to see just what's going on. Are you where you need to be? You'll see later in this here presentation, but 620 credit score is what we can do right now. However, we are encouraging buyers to be at a 640, just because we'll talk about that a little later too, just because it involves some costs and just because of where we are. I know people may be saying, God, you got to have a 620 credit score. I thought it could be lower than that. There once upon a time was, until COVID hit. And when COVID hit in March, everything changed. And believe me, we had to change too. We had to get used to that because we were used to helping a lot more people, under a certain credit score. So it used to be 580. Honestly, we don't know when those days will return. This may be the new norm for a little bit of time. So, which is not the worst thing, because you want to have good credit when you buy a house. A house is a major investment and is not something that any of us should take lightly. So having good credit, great credit, excellent credit, it goes along with, with all of that. So it should just be what you want anyway. Okay. Also within that credit review, I'm going to look at your debts just to kind of see where things are lining up a little bit based upon the application, the information I've taken on the application, just to see if things are even lining up just from that snapshot view. Okay. Then if we are in a position where we can move forward, I usually give that feedback and let you know if we can or can't. Then if we can move forward, you're going to submit your income and asset documentation. That's going to be a deeper look. That's usually where Mr. Foster comes in. I get it all organized and pretty, and I kind of hand it off to him. That's where the team and Team Foster comes in.
The handoff.
Yeah, I hand it off to him. He's very good with, setting it up and getting the interest rate and structuring the loan and everything. So that is Jimmy's strong. That's his strong set. So, I rely heavily on him to do that, probably too heavily some days, but that's what he does best. So once Jimmy has taken a look at that, the file is reviewed for the pre-approval. Then the last step in this here process is to get your pre-approval letter. Now, just to kind of let you know, you do want a pre-approval letter. We do not give pre-qualification letters based upon credit. And that is because things can look one way on credit and on an application. And then when we get documents, things can start to look differently.
The game changes.
Yeah.
In other words.
Yep. And we'll go through some of those things too. So, but just know that the mortgage loan process, it has several moving parts. There are various key players in here that have to work together as a team to get our buyers to the closing table. I think Jimmy said that can be anywhere from about how many people?
Well, five to 10. You might only hear from 1 to 3 people throughout the process, and that's a lot of times what people think it is, but it's almost a team of 5 to 10 that it takes to get through a loan process and well, home purchase process. I don't want to just say just a
Right.
loan process, because you still have your real estate agent, then you have title companies, you have underwriters. You have all this back end. Attorneys are always tucked back there in the dungeon. So you got all these different parts to have to deal with, comply with to get a loan done. But it's our job to navigate you guys through that to where you're only dealing with a couple of people and
Right.
not all those others.
Right. So how do you get to this process? How do you get to this part of it, right? So how do you get approved? That takes a few things, just takes a few things for us to be able to do. So Jimmy, you want to go over this here, or you want me to do this?
No, I can go through it. You probably need some water now.
Yeah.
All right. So, when you initially start application, like Felicia says, she's usually that initial go-to person in the beginning to get everything set up down to the meat and potatoes. Because if I'm taking applications or we're both taking applications all day, then nothing else is getting done on the other end. So we got to be able to split that up. So it's going to initially start with, once she takes your application, going to pull credit. Now that part is going to be analyzed first and foremost to make sure we now go to the next step. So based on your credit score plays that initial part to make sure, okay, you have a score that's now doable. But then the deeper look at that credit is just not just scores, so to speak. That's just one part of it. A lot of people get caught up in just the credit scores, but we got to look at the overall profile. With the credit scores that you have, what's on that credit. If there's disputes on the credit report, some people can have 680 credit scores and everything's in dispute. If you put on disputes while you're working on credit, disputes generally pull that account out of your credit score while it's in a dispute process. Pretty much almost all loan programs these days do not like disputes. And if you have disputes, we're going to come right back to you and tell them, take it off, get it removed, and we got to rerun credit without disputes so we can know what your true score is. So credit is analyzed from that, see what kind of items you have on credit, whether it's cars, credit cards, installment loans, how much you have left to pay on them, what are your minimum payments, what are your balances on there, because sometimes those balances can play a part in your credit scores as well, mostly on credit cards. Sometimes we can coach you through sometimes it's a simple thing of paying an account balance down, which you might have already done. It just hasn't reported on credit yet, but it can mean the difference of 20, 30 points for some people where, hey, you're a 620, you want a 640, and you got to pay $300 down balance on a credit card, which you've done and just haven't updated yet. But we get that updated, you're a 640, and that's like night and day on some loan programs. So we'll go through your credit with you in detail, ask questions, look over everything, and make sure everything's in order, or give you ideas or coach you. We have scenario systems. What do they call? What's the word? Simulators. We have simulators that we can use to help project what a score would do based on some of the things you may need to do on credit. So once we analyze that, if everything's looking pretty good to go there, then we're going to look at your income. Initially on application, what you give us is what we're going to kind of use from that point on. But if things are looking good, we're actually going to get the income documentation in with that to back it up. What you give on the application and what you provide, of course, have to match up. We've seen all cases. So we've seen where we're given one amount, we get income documentation, and clients make a lot lower than what they gave on the application. Or, vice versa. Sometimes people understate what they really earn, and when we get the documentation is actually more than what they've indicated, and it can sometimes work in their favor. So we're going to analyze that, your income, where is it coming from, your sources of it, everything else, to make sure we can use all of that income for proper qualifying. Then debts, that kind of comes back a little bit to credit as well, but then there's some off credit items we'll also confirm. But with your debts, nowadays the biggest hurdles of purchasing, the major hurts in purchasing are student loans.
We'll get to that later.
Okay. Well, I won't jump the gun.
Don't jump the
But we'll
gun.
analyze your debts.
Yes.
And when I say debts, is mainly things that are reporting on credit that you have to pay, as well as the non-debt items are things like child support or alimony. If you're on an IRS payment plan and you have that, or some car notes or something that's not reporting on credit but will get identified through bank statements. Those are the things we're trying to make sure of. But don't mistake debts with bills. Some people thought they couldn't afford anything, and they're counting light bills, electric bills, cable bills, cell phone bills, daycare.
Yeah.
Those are expenses you have, but they're not considered debts. You can technically walk away from them anytime, and they're not come and take your house as a result, or anything like that. So that's debts. Assets are your financial monies that are available through your bank statements, savings, incoming bonuses, incoming settlements. What else am I missing here?
Stimulus checks.
Yeah, stimulus checks, tax refunds. That season's wrapping
refund.
around.
Yes.
As a big purchase season. So if you're thinking about purchasing the first quarter of the year, get with us before you file taxes, so we can let you know what you need to do to get that done the right way for your tax refund season. But 401k, stocks, things like that, those are all financial assets as long as you have the ability to withdraw them. If you work for the employee retirement system of Texas, usually state and city employees, you have strictly retirement plans. Some people have a lot of money in it, but sometimes those retirement plans, you have no ability to take funds out of those unless you're retiring basically. So those unfortunately can't be used as assets, but that's really those unusual cases. That in a teacher retirement system, you only get those at retirement, so you can't take money out for any other reason outside of when you retire. So we can't use that as assets. But we look at all of those to see what you have available, what you have coming in, or what you have access to be able to complete a home purchase. Then the collateral, that's the house that you're buying. So, reason we want to know that is to get an idea of what you're buying. Are you looking to buy a condo, a regular existing home, a fixer upper, a home out in the country where it might qualify for rural development? Those questions may seem a little off, but that makes a difference in the types of financing. If you're looking at condos, condo is unique, its own unique way of getting done, depending on where the condo is and what's the status of that condominiums association. So, we'll kind of look at that, or a mobile home. So I've learned to stress that over the years, because I've given pre-approval letters and people got out there buying and going at it and never tell me, and they come back, found a house and 200,000 everything, and they come back and it's a mobile home. And it's like, hey, I mean, that's great. You found a $200,000 mobile home, but mobile home financing is its own animal. Those numbers that I gave you, those estimates I gave you, sorry, kind of throw that out the window. It's a little bit different from mobile home financing. And now, the game's changing a little bit. Mm-hmm. And last one there, this thing is blocking it.
Oh, costs.
And then costs. We always like to cover what kind of upfront costs that you should expect going into a home purchase as well. So it's a lot of moving parts, but then there's certain costs you're not paying till the end at closing, or getting taken care of throughout the loan process and taken care of at closing. But then there's certain upfront costs you need to make sure that you're prepared for. We cover that later, or am I jumping the gun?
No, you can do that. No,
okay. See how this works. So yeah. So usually, Ashley will cover things like your inspections. Those are costs when you buy a house that you may incur up front. You just got to have money for that up front. Has nothing to do with getting a loan or the lender. But when you inspect a house, you want to make sure that is good or is meeting your satisfaction. That inspector is going to spend, anywhere from 1 to 3 hours in that house, going through it with a fine tooth to let you know everything that's going on with it. We do like to tell people, do understand it's the inspector's job to give you all the good and bad on a house, but don't let it freak you out, because it doesn't matter if your house is brand new built. It's a guarantee an inspector will find something. So, don't freak out and think everything is bad because an inspector's finds something. There's no 100% inspection-free house, I guess, if you want to say it.
Issue free.
Or issue free. I've bought, built everything, and you get an inspection. I mean, they'll find, hey, the caulk is a little bit short here. Stuff you can fix, as I say, with a butter knife on the weekend. But they're going to indicate it. So, but prepare for that. Appraisals. That is based on your loan, a lender required item, an appraisal. An appraiser has to go out there and view the house and make sure it's worth what it's being sold for. Now, don't confuse those with an inspector. The appraiser is hired as a neutral third party to just value the house and make sure it's worth what it's being sold for. An appraiser's in that house anywhere from 10 to a max of 30 minutes. So they're not checking it with a fine tooth comb. They're just making sure it's in basic, safe, livable condition, depending on the loan product. Because there are some loan products that almost don't matter what the condition of the home is. They just want to make sure it's worth what it's being sold for. Your government loans, they're going to want it. They want to make sure all the safety, major safety things are being met. But they're just going to analyze that house for value. And that's an upfront cost that you pay before you get to closing that you have to be ready for. Most appraisals in the DFW area are going to run from $550 to as high as $675. We've seen a couple of 700s here recently because of just the volume in the market. And I think appraisers knew it was so busy, they're just fluffing some costs, but that's me griping. All right. And so those, and the biggest upfront cost to prepare for is your earnest money deposit. Whenever you put in an offer and someone accepts your offer, they're going to want some good faith money that they're taking their house off the market. We got a serious buyer ready to make something happen, and they're putting their money where their mouth is. They're putting some upfront money. Don't worry, that upfront money that you put will be counted as money you paid into the transaction, as long as you can document it was your money. So any cash under the bed and everything, let me just get that out the way, cash deposits, mattresses, freezers, sheds. If you're planning to buy a house, get that money into an account as quickly as possible. So it's been in the bank for at least 2 months or 2 bank statement cycles, and it can count as your money. So, do that. Anybody owe you money too, collect your money and get it in the bank quick and let it cycle in. Because, we get a lot of people who get paid back during the process, and magically we can't use that money that, hey, you had only $900. Now today you got $2,900. And, Reggie owed me 2 G's from back then. Well, you can't just stick that in the account and all of a sudden we count it. It has to be seasoned. So, go to all the folks who owe you money and start collecting it if you're getting ready to buy and put it in the bank. Then you won't have to explain it, a month and a half, 2 months from now. So you're good there. All right, you got the next. What's the next slide?
Financing options.
All right. Financing options. Want me to cover this too? See, this all the stuff I get into after y'all take the application and she bring it to the dungeon, my office. I never leave the office because she lets me go to the bathroom, y'all. I get food from time to time. Sometimes I eat when I get home, but
Jimmy's just messing.
It's how it goes for me. All right, financing options. All right. Is really there's a bunch of loan options out there that you'll see and hear on billboards. In the end, it comes down to these are the big 4 loan options in the world of home lending. It is not that complicated. It's really four options, and really these are the base 4 options. And then one other option out there is it's just really some type of specialty loan out there. They call those non-qualifying mortgages. As a fancy term, in the simple terms, is like hard money. If you know what hard money is, that's what those loan options are out there. So people looking for some of those specialty programs, that they are there, just be ready to pay for it. You know, they offer them, but they're very unique, and they understand the niche that they're in, so they're going to charge you for it. It's for people who just have that extra money and they want to get around things and willing to pay to get around it, and not concerned with terms and costs. There are those clients that are out there, those products are perfect for. These four here, a conventional loan. When you hear a conventional loan is basically, historically is considered your bank loan. Basically, it follows the standard banking rules. A conventional loan. Used to be back in the day, these were the loans that required 20% down. So when people hear conventional, they think I need 100% excellent credit and 20% down. Well, that has changed over the years. A conventional loan, yes, 20% down is an option. You can do that. Where 20% used to be a requirement, 20% is more or less, those who can, they do it. But sometimes to get to 20% down, that means in a lot of cases, it can be your risk level. And with conventional loans, they are truly profile driven and they're risk-based driven, a combination of those. So you have to look at your overall credit profile. Generally with conventional loans, they're going to look at generally at least a 3 to 4 year credit history, you know, overall, and what your profile looks like. No two scores necessarily get the same thing in conventional, unlike some of your government programs. Whereas, hey, if we have two people who are 660 credit score, it doesn't mean they'll both guarantee conventional approval. Somebody with a 640 with 4 years of credit history and may have owned a home in the past, have some mortgage history, they'll get an approval a lot faster than even somebody with a 670 or 680 credit history, but everything's new, 1, barely 2 years old of credit history. And then, you know, there's just not enough deeper beyond there, may not have as much money available as someone with a lower score and mortgage history and been on a job a while with retirement assets, things like that. So it's completely profile driven, but when people qualify for it, we always give it as an option. We look at that option first because it, you know, is more computer automated driven. If it likes you, it likes you. If it doesn't like you, we can play with it until it does like you. But by that point, when we're letting you know what it takes for you to like or to like you, you might say, what's the other products?
Right.
So, but, you know, we always explore that option. But conventional, it gives you the most leeway on a property. So when I mentioned appraisals, some times it doesn't matter what the condition of the house is. Conventional is that loan, where a house can be a fixer-upper, it can be in any condition. The appraisal in the end is going to be fine. It just whether it is worth what is being sold for or not. All right. Now, FHA, well, let me jump back. Conventional, I mentioned the 20% down, but with conventional, you can get in with as little as 3% down. If you've owned a home in the last 3 years, the lowest you can put down is 5%. They don't give you the 3% option to put down. That's for first-time home buyers or people that fit in certain low-income categories, you know, based on the region that you live in, where there's conventional has these home-ready programs, HFA, Housing Finance Authority type loans that, you know, we can use under conventional, get you in there with lower down payments. But their minimum is 100% a 620 score, and that has never changed despite COVID. That was always their minimum requirement.
Yes.
FHA, now we're getting into the government loans. The next three are government-backed loans. FHA is your most popular loan that's out there. It's probably, I mean, it's the most widely used loan in the country. FHA is just backed by the federal government, but it's not the government giving you the money. They're just insuring the loan for the lender. If there's some default at a certain point, they'll reimburse the lender for some of their losses, not necessarily all of it. They still want the lender to take on some risk and assess everything. So, but with FHA, they require 3.5% down payment. That's of the purchase price. So, you know, if you're buying a house that's $200,000, 3.5% down payment, that's $7,000. They require that as the minimum you need to come up with out of pocket on that. You know, that's outside if we get some other programs. We'll cover that here shortly. But with FHA, they require 3.5% down, no matter what, whether you're a first-time home buyer or somebody else buying again. That's the requirement for everybody. Those programs are good because they have a lot of flexibility. Now, COVID has tightened up that flexibility, you know, quite a bit. I mean, you know, we could have did 580 at 3.5% down with FHA prior to that. And even we can do down to 500 credit score if you have 10% to put down.
Yeah, it's in the past, right?
Yeah, it's in the past. So, but you know, it may come back one day, but you know, who knows? You know, we'll see. Is we're only what? Well, not only, but we're approaching 7 months into this mix.
Yeah.
So, but with FHA, like we said, it has a lot of flexibility. You know, you can have some dings and stuff in your credit history and things like that we can get around and work towards. I like to say FHA is a box that it's flexible in certain areas. Conventional is little bit of flexibility. FHA can be stretched out a lot, but you know, with that one is the number one go-to loan for that. VA is veterans loans by the Veterans Administration. So if you're a military vet and you have a certificate of eligibility, or you know, you don't know, or you are a vet and have never used it, just give us a call. I can pull and see if you have a certificate of eligibility, and you know, try to get you there. Now, hands down, if you're a military vet, there's no need to be shopping around for all these other loan products. Nothing is better than a VA loan if you have the ability to use it. So it's only if you've done something, usually you'll know, you know, if you've done something where you don't have your VA eligibility, and you should have it, you know, as you know, maybe you foreclosed on a prior VA home and they took losses and you never paid them back to get it reinstated, or you know, you owe the government money. On that applies to FHA, VA, and USDA. So if you're delinquent on any federal debt, all of them are gonna shut you down. So you know, stay on that. That's defaulted student loans, SBA loans. You know, if you know. We don't deal with it too much here in Texas, but you know, I have family in Louisiana. You took some FEMA money and didn't pay FEMA back, and you should have. They've marked you in the system. If you're delinquent on federal debt, 9 times out of 10, we will find it, whether or not it shows up on credit, because there's systems we got to check, award systems we have to check to make sure you're eligible for government financing. So, you know, get on top of those student loans. If they, you know, went bad and stuff in the past, they have amnesty programs. You know, call the your student loan servicer and get them rehabbed and rehabilitated and back into the fold. You know, they're all fixable things. So you're never just 100% down and out. It might not be right now, but here's what you need to fix. But a VA loan is 100% financing, no down payment required, but you still have closing costs and prepaids. USDA rural development is the next closest thing to a VA if you're buying in a rural development area. Now, don't misunderstand rural development, that everything is just, you got to go way out to East or West Texas only. Your next neighbor's 5 miles down the road. That's not, no. It is based on certain population in areas. DFW, most of the USDA areas within the DFW circle have kind of run out. Little Elm was among one of the last ones that closed out. Midlothian still has some stuff in USDA, but when you start to get to the outskirts, certain areas, maybe, you know, around Forney, Heartland, getting out there, you can peek in. I'd have to look at the map again, but you know, if you're not certain and there's a house you're looking at, just ask. Or if you Google USDA eligibility, they have a system. You can just put in a property address and it'll tell you if it's eligible for USDA financing or not. Yeah. But they do have a specific box you have to fit. It is credit score and debt to income ratio driven, and their box is not flexible at all. And so if you fit in there, we'll get it done. If you don't fit and you're trying to fit, 9 times out of 10, it won't work. everybody we've tried and we've learned over time, we try to tuck you in that box, 9 times out of 10, they're going to find a way to untuck you. Either you're going to fit in it nicely and we're good to go. But if you're borderline, I'd probably be hesitant to have you go out there to get it, because they'll find a way if you're that close. To me, that's what it's been historically. They find a way to untuck you if you're that close.
Right.
But with down payment, when you're hearing these down payment percentages and amounts, and it's telling you how much you need for down payment, that's not all the money that's needed with this. That's the ugly part of this. You hear down payment and you think that's all I need. Yeah. I'm ready. I have $7,000, 200,000. Here I come. Well, you have the down payment, but then it's that other side of it that's in small print. It says plus closing costs and prepaid expenses. That's where we get the whats and the bleeps and everything on the phone when you hear that other side of it. So if you ever watch the car commercials, they always tell you these nice prices, and then the fast talk on, and you see stuff at the bottom in small print. They always have this plus TT&L, plus tax, title, and license. Well, that's almost the same with houses. So when you're buying, you have whatever you're required to come down with. That's your requirement, whether it's 100% financing, meaning 0 down, 3.5% down FHA, or 3 to 5% down conventional. That's just what you're required to bring. Now, closing costs and prepaids are still required to be covered by you or somebody. Plus closing costs and prepaids, in today's DFW market, the average on that is 3 to 4% in itself. So if you're thinking FHA offhand, I need 3.5% down plus another 3 to 4% for closing costs. Heck, that's 6.5, 7% that I need.
Mm-hmm.
You're right. If you're going in this, buying this with no assistance, no help, no seller help, nothing, I'm gonna do this all on my own. Hey, you need about 6 to 7%. Calculate that. So if you're buying a $200,000 house, I'm gonna need $15,000 to $16,000 to buy this on my own. And there are people who can do it. There are couples, individuals who have the funds to do it, and they do it all day long. But some people need special help. And, and that's where we come in. We are a lender that offer down payment assistance programs. Those programs are available. Most of them we do the main state funded programs that come into play to help. So we get quite a few calls for those. If you fit those, most down payment assistance programs, they do have credit score requirements, and they've gotten even stricter during COVID. They've taken some of our fun away since COVID. I'm tired of hearing the word COVID, probably like everybody else. But, they'll have their requirements. So if you go in, if you meet their minimum credit score requirements, most programs, have a 620 to 640 credit score requirement. Right now during COVID, 640 plus is almost pretty much mainstream across their boards. And then some of them is 640 to at least get down payment assistance, but they shrunk the box down where you can't stretch it. Even though FHA is flexible, it can be FHA with down payment assistance, and they've taken FHA box and shrunk it down to here, and you got to fit in there. For instance, like T-Shack, their Texas State Affordable Housing Corporation.
Mm-hmm.
Yeah, they have down payment assistance. Is a pretty popular one. They help teachers and heroes and everything else, but they help everybody. The program's really for everybody. Mm-hmm. But they added requirements in May after COVID, where 640 plus you can get assistance up to a certain debt ratio, like 45%. Well, we have a lot of people getting between 48 to 52% debt ratio. Well, they changed their rules, and as of May, they made it, you need a 700 plus score to go over 45% debt ratio, up to as high as FHA or loan products will allow on there. But if you're below a 700, they've capped that off. Those were never restrictions in the past. So, but with down payment assistance, we look at those. If you qualify for it, we will make that an option. Still always work towards being able to fund a purchase as much as you can on your own. The assistance is there to definitely help you out. The people that have the most success with down payment assistance programs are the ones who a lot of times don't 100% need it. That's why the word assistance is really there. You know, we'll use it to the fullest when it's available there if you truly need it. But you know, aim to try to have it, and then the down payment assistance works even better when you have the ability, or you darn near have the ability to fund this on your own. But we can use down payment assistance and not be concerned that if anything's slightly off or anything like that, and you either fall out of down payment assistance requirement or anything changes, you don't lose your home purchase. You can still get it done. But the down payment assistance gives us that extra boost, gets us over the hump, and you can really almost sit back and know we're getting this done. Because I got more than enough money. I don't even need to use it. I can get in, furnish a house, and I have money left over, and the down payment assistance help me out. Right. I can talk forever on this stuff, so I'm trying to do it.
So there, we want to have, for sake of time, there's a slide that we'll just skip over that one because it's not really essential for getting pre-approved. It's really once you have a contract and you're moving through the actual loan process. So we'll skip over that because the thing that some people want to know is, well, I'm not ready yet, but how do I get ready? So I usually call this, in your season of preparation, when you may not have the credit score, or you may have too much debt. You may not, just be able to, afford right now, or for whatever reason it is. These are some of the things that I've just kind of outlined that you can, work to, improve credit while you're in your season of preparation. I do advise, or we do highly recommend people to have some type of credit monitoring. Credit Karma is just not reliable. I know it's free, but it really is.
Marketing machine.
It is a marketing machine, but truly it just does not give you the best snapshot of what your credit looks like. We're in mortgage, but we still monitor our credit with something. I just I've been using Experian for a while, and I wanted to know where my scores were. Well, all three of my scores were. So I went ahead on and I paid the whatever, I think it's $20 to $21. Actually, it's a 7-day trial that I probably need to cancel. But I went in and I was like, let me see what my scores are. Because Jim and I, we're about to refinance our house because we want to take advantage of the low rates. So we hadn't, looked at our scores. So we were like, well, let's see what the scores are. And we both did Experian.com, and it gave us some pretty accurate scores. Actually, our mortgage scores pulled higher than what it gave us. So I do recommend that, even if you do the 7-day trial, just to look at it. But I'll be honest, even when you stop it, they still will give you your Experian score, I believe. So you can take a look at all three of your scores. I really like it. Shows you your credit utilization and what you can do to get your scores up. So just my recommendation, because we've used it personally.
Yeah, really just use scoring systems that focus on the FICO score.
Yeah.
So the reason Credit Karma is way off, they use the Vantage scoring model.
Mhm.
Vantage is more geared towards consumer, credit cards, department store cards, things like that for spending. So their scores are going to always look a lot higher than what your FICO actually is, because FICO is what mortgage banks have to use. So all of us as mortgage companies, we all have to use the same scoring system, the FICO score 8, FICO score classic. So look for credit monitoring programs that utilize the FICO system. That's going to give you more accuracy as far as what a mortgage lender may pull for loan qualifying.
Mm-hmm.
Just know if you're in the high 6s or 7 for mortgage lending, you qualify for everything else.
Right.
So because everything else is going to have a higher score requirement. So focus on your mortgage credit scoring. If those are good, everything else is good in general.
Right. So just while taking care of some of those credit things, I just had have a couple of bullet points of paying off credit collections. Those may or may not include some medical collections. Deletions are very, very important when you're paying when you're paying any type of collection or a charge off. I know people, like for us in mortgage, we really don't count charge offs in some aspects, because there are some times where we have to, if your collections total too much, it says in that next part in the debt section, then we have to count like 5% of that in a monthly payment. But just in charge off, sometimes if your credit is struggling to get higher, if your scores are struggling to increase, then that means that you have to tackle the next thing. And sometimes that may need to be a charge off, okay? And eliminate any judgments or liens, especially those that may impact you qualifying for a government loan such as FHA, VA, or USDA, which Jimmy talked about, because we do have those systems that we will have to look into. And if you're on that, then you won't qualify for those loans. And usually that's if you have IRS debt or federal or your student loans, those are the things that will impact your government loan qualification. Assess your debts, keep debt to income ratios as low as possible. Review we will review you for how your student loans will impact your purchasing power. Jimmy kind of talked about this, and I have it listed as one of those silent debt killers. Student loans for FHA, if you have, just say the average person that we are seeing probably has about $100,000 in student loans. So if we imagine if you are going for FHA financing and you have $100,000 or more dollars in student loans, we have to count 1% of that. Already for $100,000, that's $1,000 off the top that we have to include in your debt that you may not necessarily be paying. So it's important to eliminate the other debt or reduce the other debt if student loans are, if you have a lot of student loans, or you will need to qualify for conventional financing. And conventional financing just is not a guarantee because of the reasons that Jimmy talked about. It's not just your credit score, it's credit profile. So it's not always a guarantee. Other things that you want to do, like I said, the medical debt, the medical collections, the non-medical collections, because those things in some situations or scenarios, we may have to count a portion of that payment in your monthly debt. And then I just said, keep a balance of debt, installment loans and revolving credit with major creditors. It's important to try to keep a credit card with a major creditor. Your Capital One, your Bank of America, Wells Fargo, Discover. I know, people like to open up a Kohl's or, a Sears or JCPenney, but those are just not, major credit cards. So try to do, like I said, a major credit card, because those things, believe it or not, they have a rating that they will rate those creditors. And the department store credit cards get a lower rating. So you may have them, but they may not be really helping your scores, okay? And then the silent debt killers. Jimmy was alluding to this earlier. Student loans that are not fully listed on credit and collection status, but they still exist. We've had people that their student loans went to collection and it just said transferred, but it doesn't tell us where it transferred to, and it doesn't show up anywhere in your on your credit report. Those things have not disappeared, but for some reason people do like to bury their head, about it and just think that it may have gone away. Those student loans, if you took them out, you are still responsible for them unless you are in a debt forgiveness program. And I haven't seen anybody come out of debt forgiveness program just yet.
Yeah, they haven't been around long enough.
Yeah.
Most of them are 10 years. So we haven't gotten to that 10-year mark to officially witness the full forgiveness yet.
Yeah.
But yeah, student loans are big things. They're not discharged through bankruptcy. Mm-hmm. If they were, it'd probably be a run on bankruptcy courts. But They're not. If you've gone into collections and they've disappeared off your credit and showed transferred, and student loans are notorious. They will not say a word for like a decade.
Yes.
We've had people find student loans from 15, 16,
1986.
1986. Had a lady, yep, student loans, nowhere in sight, 700 plus credit score. She can qualify for every program, right? Yeah, well, she was going for FHA and they ran that check, and all of a sudden, you know, her $6,000 in student loans from 1986 had interest up to 24,000. And it's like, okay, well, you got to get on a payment plan with them. You know, it took a few months to get it rehabilitated. She got it back going, but they just sat there. I mean, shoot, lady had kids and graduated, and the student loans got discovered. So that's one of our biggest killers. So just stay on top of those. There are programs, and hopefully, you know, HUD does something here real soon to change how they look at student loans. So conventional has been proactive. If you're on an income-based repayment plan and things like that, even if it's a zero payment, conventional has options that allow us to use the income-based.
The VA does.
Yeah, the VA does. If you're a VA and they're deferred for 12 months past your closing date, we don't have to count them. Or we count a much lower calculation than what FHA uses. So, and USDA, same thing. They even offer some flexibility. FHA, not so much. IRS judgments, liens, that's not on credit. Those are the ones that drive real estate agents crazy. When we give them a pre-approval, everything is good to go, and I got to call them later in the process, and we discover something that got dug up through the process. Sometimes we don't even find it. The title company find it.
So,
and you know, that means you're already deep in the process, and the title company calls, hey, we found in this deep court record, you know, some landlord sued the person and won, and it's just sitting out there. So try to be aware of that. And then debt that's not on credit but on bank statements. When we ask for bank statements, we're not only looking to see how much money you have, but they're looking at is to make sure that you're also managing your bank account. Don't have a bunch of overdrafts, one or two here, you know, I wouldn't say here and there, but one or two or something like that won't hurt you. You just might have to explain it, but make sure it's not month in and month out. You're getting, you know, 2, 3, 4, 5 bank drafts every single month. You want to get that back on track, but also they're making sure you're not paying any other debts that look to be coming out every month consistently that's not showing on credit. So not because an underwriter will catch it. I don't know. These people go some extra training, they find stuff. So just, you know, have it in order. We're going to dig through it deeply, but they'll watch it.
Can you talk about child support?
Oh yeah, well, child support too. People try to get around it to show up on pay stubs. Those pop up in judgments and stuff too, but you can still qualify if you're behind. If anybody's paying child support and they're behind on it, they're going to want you to bring it back current or be on kind of a repayment plan where you're now paying child support, and part of that support includes an extra amount to catch up what you're behind on, and you're paying that current. Then, you know, we can get around if your credit is showing that you're delinquent on child support, but you've been paying. It's just you're slowly paying back what you owe. It's still doable that way.
Yeah. Right? And the last thing, guys, when in your season of preparation, just save whatever you can, wherever you can. Because even if you don't need it, or even if you don't have to use it, you know, in the transaction, it just really helps with building your credit profile. I had to call a guy today and tell him, hey, we can approve you, but I need you to have 2 months reserves, you know? So that does come up, and he has to have 2 months of, you know, mortgage payments because his credit history is just a little shallow, and he just, you know, he's deemed a little bit of a risk. So desktop underwriting, the automated underwriting system says we want you to have 2 months of reserves, 2 months of mortgage payments. So it just helps. It helps your overall approval. So Ashley, that's it. What do you have for questions?
I think other Ashley has a question.
Okay.
What you got, Ashley?
Hello.
Hi
Hello.
there.
Hello. Thank you for letting me decorate my Christmas tree at the same time. Christmas is
Ah,
Christmas
you
is
getting ready.
serious business in my house, so I start very early. Um
Nice.
so my question is about title insurance. Is title insurance required or just highly recommended?
Title insurance is required.
Right.
Now, when you're buying a house, there's two types of insurances you're going to get. There, the lender, there's the lender's title policy that's always required. You're getting a loan, so they got to know that the title company or attorney's office that shows for closing, they do a lot of back end work to check out the history of that land, the chain of title on that land, to make sure
Mhm.
you're getting that title free and clear. And they can only search probably as good as records can go.
Mm-hmm.
So they're performing that search, and they're issuing that insurance policy, or the lender's getting that policy issued that's telling them that, hey, we did research on this. It is free and clear and coming over to this buyer as good to go. And that's what that title insurance is for. So if you're sitting down relaxing on a Sunday and somebody knocks on your door and says, hey, my great great grandpa left me this as my inheritance, this is my land and everything else, and you looking at them crazy like this is my house, I bought it. Well, sometimes they can take you to court for that. We've never seen it happen, but it has occurred, which is why title insurance got created. And that title insurance then comes into play. You can go back, sit back down, and hey, I got title insurance. Here's a title company. There's a title policy out there. Or tell them, call my lender if you still have a loan. The lender has attorneys and everything else, going to pull out that title policy, and is going to go into effect, and let the lawyers handle it, pay this person to go away, and you keep going about your business.
Yeah.
But also what's in there is an optional, what's called an owner's policy, which is a title insurance policy for you as the owner. That is optional.
Mm-hmm.
Most get it because it's usually between
Yes.
100 and 150 bucks.
Mm-hmm.
So, most people won't pass on that. The title policy is a noticeable fee. It can be close to, just under 1% of the purchase price, speak a little bit less than that, maybe about 0.75% of the purchase price. But that's noticeable fee, but that's not an option when you're getting a loan. So, with that,
We don't know where there's kind of
yeah,
no way around it.
there's no way around it. Texas is a little bit more expensive with it than maybe we see in other states, but it all washes out. And it's the same for everybody. It's regulated by the Texas Department of Insurance. It is based on purchase price and loan amount. So it doesn't matter who you are, where you're going. It's all going to be about the same cost everywhere because it's regulated that way. But they have to have those built-in protections, and they want to make sure, yeah, nothing was missed. Somebody didn't record something correctly in the past, and it comes back to bite later. I want you to have peace of mind that it's your property.
I have one more question that I just
Yeah.
thought of, but it's okay to ask.
Oh yeah, what you got?
Okay. I know for some auto loans, I'm wondering if this kind of same scenario is applicable to home loans. I know for some auto lenders, they won't finance a car if it's so many years old, like if it's too old. Is that scenario at all in play for a home if the home is too old?
No,
Never had it happen.
no.
I mean, we've had houses there 50, 60, 70 years old.
Well, we've had Louisiana,
And yeah,
100
yeah,
year.
they
We had
have houses built in the
100 years.
1920s.
Yeah. So no, home age is not a factor as far as lending. Condition
Yeah.
of it will play a part, because 100-year old home can be just in perfect condition. We don't run into it much here in Texas. We see it more in Louisiana, where the only time for the most part we've seen where older homes play a part in the lending process is during more so when you're getting government loans, where like in Louisiana, FHA loan, somebody ran into, it was the electricity was so old in there.
Oh,
It
The wiring.
Yeah.
it wasn't no breaker boxes like we know. It was that U-shaped thing that just goes.
Oh, that's a cool.
That one was a
That one couldn't
That was a
go
new
government financing because they deem that under today's code, that's a pure fire and hazard risk.
Gotcha. Okay.
Yeah, there's no circuit breakers. If too much surge comes through that house, that thing's just gonna flat out explode.
Yeah.
Fire. So but it could go conventional, all day long. But for the most part, it plays no part unless it's some unique historic type of property that's under certain historic protection.
Yeah.
And that's very rare that you'll see those just listed for sale as a regular sale. If it's historic, usually there's a process it has to go through to be sold.
Right.
Okay, thank you. Appreciate that.
So I've had this question come up to me. If it's a husband and wife, as far as getting their approval, is it based on both? Is it based on the best one? I know I've gotten questions about that.
All right. So yeah, now where it comes into play on conventional loan, we can go any kind of way with that one. It has flexibility. On government loans, Texas being a community property state comes into play. So during our application, we ask people the question of if they're married or unmarried. We ask it that way.
Separated.
Or separated. We ask it that way for a simple reason, because if we just say, are you married or single, we've had married people who just who left the marriage, didn't divorce, and officially in the marriage saying I'm single. Well, we're still community property state. As long as you're officially married, that spouse has some rights. So so when we're looking at a government loan, when you're qualifying, of course, we like to look at it jointly. We always really have to look at it jointly. And with all loan qualifying, if income and credit is being used for both people, especially income, then their credit scores come into play. And you're going to always qualify on the lowest of the two.
So, the lowest of the two middle score.
Yeah, between the two of you, the lowest middle score. So when we pull credit, we always pull a tri-merge, all three bureaus. The middle score of the three is what's going to be used for loan qualifying. Which middle that is just going to depend when we pull all three, which one falls in the middle. Sometimes people have two of the same score and one lower one. Well, the middle score is two of the scores. It's the same. But it's going to be the lower of the two. But in the case of where, let's say you have one spouse with an 800 credit score, the other spouse has a 580, can't even get a loan right now. Jointly, they can't get a loan together because we got to use the 580 under the current climate. 800 credit score will be scratching their head now. Of course, but the way of getting around that is if the 800 credit score makes 90% of the income, and we can scratch out the income from the other spouse, and that person with the 800 credit score can cover all debts between the two of them. Looking at both credit reports, we got all the debts accounted for, plus the cost of the house payment of the new house. If that person with the higher income and higher credit score can support all of that, we will qualify under that one person and get it all done despite the credit score of the other person or spouse. Conventional loans are the only loans in a community property state where a husband and wife can operate sole and separately. We can qualify under one or the other or both with that one, if their credit profile. So in this case, if someone had 800 and the other was 580, we'll immediately, let's look at FHA. If you want to go FHA, can you cover debts and get it done? Yes, we move forward. If no, okay, then, well, now let's look at conventional, where now we're only looking at just that one person by themselves specifically and whatever their buying power is. And we try to pursue it that way. So, but generally, yeah, community property state, the only way to qualify on a government loan with using the higher of the two scores is if that person with the higher score can qualify. All right. See, Fred raises his hand. Where's Fred at?
Right here.
All right, what you got, Fred?
So my question is, I understand I use a FICO score, and from my understanding, there's like several different FICO scores out there. which one do y'all care about the most? Because I know I have a Discover card and it uses FICO 8, and so does my Bank of America card.
Yeah, FICO 8 is one of them. So I can't remember which of it's like the FICO Score 8, the FICO Score Classic.
And one is Beacon,
I
actually.
think one is like the FICO Beacon. It's
Beacon.
like three score models, but each of the bureaus uses one of those.
Oh, yeah.
So between those three, those are like the likely ones we'll pull. And that's with all mortgage banks. So those are the ones that we have to use. So if you're at least using those to kind of monitor your credit, you'll kind of be in the ballpark, if not spot on sometime.
I appreciate it.
No problem.
I had someone ask a question about land. Is land the same process as far as obtaining a loan as it is to buying a home? I guess.
A land loan by itself won't qualify under our mortgage lending licensing. When it's a land loan only, it's considered like a consumer loan, like getting a car loan or a personal loan. The qualifying, is a little bit less stringent than when you're purchasing a home, but their terms are different too. Generally, they're going to give you 3 to 7 year terms. Shorter terms because they want you to either pay off the loan fast or get something built on it pretty quick. So if you're buying just the land by itself, it doesn't fall under mortgage lending because there's technically no property or the property, but there's no real estate attached to it as far as a structure. Now, the caveat to that is like if you're doing it in conjunction with a construction loan, then we can do like one closed construction or construction loan where within that construction loan is either going to buy the land at closing, pay off the seller at closing, and then the rest of the money is used for construction. Or you've already bought the land, might have a land loan on it, and then come to get a construction loan. And within that construction loan, we're going to pay off the land. And that's the only way we can get involved with just a land only type of deal when you're in conjunction with construction loan. Other than that, you got to be able to go to a bank or a bank that does land loans specifically to at least acquire the land. But we do construction loans. They're not popular right now, but they're available.
Awesome.
All right.
I think that is.
Any other questions?
I don't see anything in the chat.
All right.
I will ask the last and final question.
Yes.
Some of us millennials have no clue what escrow means.
Oh yeah. Well, escrow can be real confusing, especially depending on what state you're in. But for Texas, is a little bit more cut and dry. Escrow. Let me start with. In most cases, escrow can mean just the whole purchasing and closing process.
Right.
Like when like out here, we say you're under contract.
Yeah.
You go to California, some other states, when you put out an offer, they accept it and you're in the middle of the buying process, they call it under escrow. And then you're going to hear escrow from the loan process and that starts confusing you. But from the loan process, what escrow is within your house payment, you have just the loan payment, that's principal and interest. And then the rest of your payment consists of, you will have property taxes, in Texas, unless you have some special VA disability or some type of exemption to either reduce or eliminate property taxes. But you have insurance and property taxes. And then one other insurance rule here in the loan process is mortgage insurance or PMI, private mortgage insurance premium. It's not the same as your homeowners or hazard insurance. Homeowners / hazard insurance is to protect the house. Storms, we get tornadoes out here, tear off roofs, you need insurance to fix that. Mortgage insurance is on any loan with the exception of the VA. They're the only loans that don't have mortgage insurance or PMI. They both mean the same thing, they're interchangeable. But FHA, USDA, and conventional, on any loan, when you're putting less than 20% down payment, you get to purchase something that's mandatory. You have no choice in the matter called mortgage insurance. That's insurance against your loan to protect a lender against losses should you default before you have 20% equity in that property. Because once you're at 20% equity in a property, they kind of deem the risk is gone. If you foreclose at this point, you have enough equity to just sell the house, pay off the loan, and start again. But when you're less than 20% equity, the cost of foreclosure and everything is more than likely assured a loss that a lender or a servicer is going to incur. So they make you take out private mortgage insurance on the loan. You have no choice in the matter. FHA, USDA government loans, they're set rates, set as a set rate percentage based on your loan amount. And it doesn't matter if you're 800 credit score or 640, is the same for everybody. You have to pay it in your loan, and that can be, some pretty decent amounts as you get to higher purchase prices. Conventionals, that private mortgage insurance is not a set rate. Profile driven, so is your mortgage insurance premium. Points of credit score is gonna rate that private mortgage insurance, coupled with how much you're putting down, is gonna change that. So that rate can have 40, 50 different combinations for each and every person. FHA, USDA is pretty much set for everybody. So everybody's going to deal with it the same there. But escrows is those portions that have to get paid out monthly or yearly to cover your insurance and taxes when they come due. That escrow is set up to where, like, let's say your total payment is $1,200 a month, for instance. Your actual loan payment by itself might only be $900 a month. That's just your straight up loan. That's the only part I can control. But the other $300 a month can be all your property taxes and your homeowner's insurance that comes up for renewal or come due every year. When you're $1,200, $300 a month of that is going into an escrow account. It's basically a savings account every month that the lender is managing and holding. So every year when your insurance comes due, they send you a renewal notice to pay this whole premium. You're just getting a copy of the notice. The notice is also going to the lender, and they're going to pay it on your behalf out of your escrow account. Property taxes too. You'll just get notices of how much your taxes are and that's due, and they'll send a notice to your lender because they're aware that you have a loan, and the lender's going to take it out of your escrow account to pay it. So the lender's going to pretty much be aware of how much your insurance and how much your taxes are every year, and making sure that's included in your payment and enough is being collected every month. So when it comes due every year, that's paid on your behalf. It's not an option unless you're on a conventional loan and you have 20% or more put down or 20% or more equity, that an escrow account is an option. But on all government loans, is not an option. It's non-negotiable. It's just what they require. But we always account for it no matter what. Even if you put 20% down, we will account for it in your debt ratios. So,
yeah.
Right. What else you got?
All right. I know I have my 5 pages of notes, but
Hey, stuff up, hey, shoot it over, ask the scenario. We love answering questions.
yeah.
Now,
Before
I have,
we'll put out
I
what you got.
real quick, at least I know, Felicia, when we spoke, something I thought was really insightful that I think others may find as well, that just blew my mind, is when you spoke to the front end and back end DTIs. I had no idea that there's a front end ratio and a back end ratio. Maybe some other people may find that like mind blowing, like I did, because I had no idea.
Yeah.
Yeah.
When you hear those terms, front end and back end debt ratios, there's 2 ratios we have to keep an eye on when we're qualifying for a loan. The front end ratio is your monthly income to the monthly house payment. How much of your monthly income is the house payment taken up by itself? For great lending, generally they want it to be less than 30%. So if you make, $5,000 a month, they prefer your house payment. 30% of that is $1,500. So they prefer your house payment to really be no more than $1,500 a month or less. That's 30%. So If you make 5,000 a month and your house payment is 1,500 or below, that looks good on that side. So we're covered on the front end. Now the back end is that house payment plus all the debts that you have on credit. Now that part has to be from anywhere from, depend on the loan product. So anywhere from a max of 45% to FHA. If credit's strong enough, it'll let you go as high as 56.9%. So if your house payment plus car notes, student loans and everything, if when those two are added together, if you make 5,000 a month, 50% is 2,500 a month. So if you're at 1,500 house payment and you have 1,000 a month worth of debt, you're at 2,500 in total with house payment and your debt. You're at a 30% front end, 50% back end. Conventional, it won't work.
Right.
FHA, it'll work. VA, it'll work.
Yeah.
USDA won't work. They got 41%. Where they come up with 41?
Well, and 29%.
Yeah, and 29%. So they're 29, 41 program. So you can be at 39% back end, but then the house payment is 33% in your income. You don't really have any debts, but it's all house payment. Is a no-go on USDA. We got to get the house payment down. So FHA will probably accept that all day long. VA, now VA is the one unique product with the exception of any special rules put in right now because of COVID that might limit the maximum. But VA is the only loan program and profile everything strong, and you have what's called residual income. Make enough money after all bills paid, and based on your household size, there's enough money left over. They can let your debt ratio, they say technically limitless. The highest one I've done is like 68, 69%. You know, back end debt ratio.
But we only did that because there were some compensating factors because it was just under the husband's income, but the wife wasn't going to be on the loan. So I think that was the only reason why we did that, because there were some compensating factors for that. Because we don't like to push debt to income ratios like that. That can be a little reckless.
Yeah. Oh
you
yeah.
know?
Yeah. No.
So the wife wasn't on the loan, and we were just putting everything, and it probably was credit or something, and so it was high back end debt to income ratio. But we knew that the wife was also making income that we weren't accounting for. Or the husband had a side gig, or something like that.
No, that's what it was. Yeah, her credit scores couldn't qualify. So this was that case of her scores were lower and would hurt the deal. His scores were good enough to get through, but we were able to max it way out.
Yeah,
we knew the compensating factor. We put her income in, debt ratios would have been like 30% back in.
Right.
So that's a compensating factor. But yeah, VA looks at all of that. Residual income and compensating factors, it can still let the debt ratio go kind of wild unless a specific investor or lender puts in a restriction, then what's called an overlay. And there's nothing we can do about it. The rules say flat out you can do it. It's the investor or the lender that can come in and add in roadblocks outside of the normal rules. So we're a mortgage banker, so we can write loans for up to 40, 50 different institutions and banks that'll buy our loans on the back end. So we can usually, we go what the general rules are, is only when the specific, if it's VA, FHA adds in their own rules, then nobody can get around it. It's FHA and VA says so. Right. It's not the bank that's saying so. So if you like go to Chase right now, Chase is almost not doing anything below 700 credit score. Doesn't matter if you're VA, USDA, or whatever it is. That's just their restriction they're putting in because they want to manage their risk to a certain level. So, that doesn't apply across the board. We say if VA says it can go down to a 620, it can be done. Might not be the best looking deal, but it can get done because there are banks that'll still buy it. And we'll get it done accordingly. But we pretty much rate to the market every day. Whatever the market is out there is pretty much where we're at. So, Geneva's not quote unquote the bank. We're a mortgage banker. We just have enough funds to write and close the loan, and one of these banks in the end will take it from us in the end. So, and Anything else coming up?
That
you
was a
think
good
of?
question. Thanks, Ashley.
Oh, yeah.
Ashley Hall for pointing that out.
Oh yeah, yeah. You was talking to Felicia when you said DTI. I have to get on her with stuff.
No. In this case, Ashley Hall has done research.
I have.
No. She's very well versed.
Yeah.
And I think I told that to Ashley Johnson. I said, now normally I can't talk, certain lingo sometimes because Jimmy gets on me, but I could talk to Ashley Hall about DTI.
Yeah, because see, when I hear Felicia do that, it's like, let them know what that is. People don't know what DTI is. That's internal.
Only because she was like very well versed, and I was like, "Oh, you've done your homework." So
Yeah.
Try to be prepared as much as possible. Try.
Yeah.
I love it. Oh my goodness. Well, does anybody else have a question? Y'all have the experts on the line.
Got a lot of people that are quiet.
They
I
are.
think that I'm guessing they're taking notes.
I think you blew.
If they don't have anything, actually, I'm sure you'll share our information with them because if anything comes up, I mean, we are available to, answer any questions that come up after this.
And I think that's the awesome thing about, we talked about setting plans for 2021. After becoming more knowledgeable about home buying processes. Yeah, I wish I did this 10 years ago. I wish I bought a house as soon as I got out of college. If I known how it works, if I knew how it could benefit me. So I think that preparing to either make changes and moves and getting ready for 2021, because unfortunately, I'm not going to get to take advantage of these great mortgage rates right now. So I'm going to cross my fingers. But that's something that I'm going to work hard for, and getting everybody on that level. So I really appreciate you guys. I do have raffle because I was keeping up with folks. Okay. So I have my green screen on, but I promise I'm not going to cheat. Okay. If Ashley Hall come up, that's not my fault. Okay. Because she asked the most amount of questions. So that was awesome.
There was a raffle.
There is a raffle. Okay.
Oh, I didn't know there was a raffle. Okay.
I'm going to do it just so y'all know.
Mr. Johnson, like, hold up, raffle.
Like, hold on now. Let me see. Hold on. I'm going to mix them up because I don't have no bowl. Okay. Okay. We've got Fred.
Oh, look at that.
I don't know, you can't see it, but I don't know. Okay, but it was Fred. I ain't cheating. Oh, see, Teresa. So y'all like to pop up when money is on the line. Okay. So I know to start off with the welcoming raffle. So next call, we'll do 3. Okay.
Nice.
Beginning, middle, and end. Okay. But I ain't gonna lie to y'all. It'll probably be $5 at Chick-fil-A. No, I'm playing. Guys. So I'm gonna send Fred an Amazon gift card. I got his contact information. If y'all don't have my contact information, it is Ashley at simplydfw.com. I think most of y'all guys do. I think there's only 1 or 2 people that I don't know who they are, but it's not too late to get together with us, with Jimmy and Felicia and myself. So just let us know if you have any questions. But yeah, I'm gonna close it out. So thank you guys for coming.
Thank you.
Right.
Thank you for having us. We enjoyed it, everyone. Thank you for your time tonight.
I wanted to ask a question.
Oh, who has a question?
I've been on the whole time. And I couldn't figure out how to put my face on here. So I had a question.
Go ahead. I'm holding.
Okay, I'm so sorry, Ashley.
I pay for this account, so we're not gonna get cut off. You good?
Okay. So look, my question is that, like, what do I need to do to prepare? I'm not ready now, but I want to be ready next year. So, like, what's the first steps that I need to do? Like, so should I go to the Experian account to get the FICO score and then start making my moves that way?
Yeah.
And another question, part two.
Mhm.
How is it about, like, you know how you get people that say, oh, they can help you fix your credit and stuff like that? So how does that work with, you trying to purchase a house in the future? Because I done seen, like, I witnessed one of my coworkers, he went through some lady or whatever, and he gave me the information, but I have not stepped foot on it yet. And so but they got the scores up, so I guess they deleted some derogatory things off his credit, and he was able to get a pre-approval and da 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 da. So I'm just saying, like, I heard like so many different conceptions about it, like it's against the law or you can't do this or da da da. So I just don't know.
Oh yeah.
Go ahead.
You know, just preparing now, even if you're looking at next year, still talk to us. It's still the time to look at things, even if you're preparing for a year. Believe it or not, shoot, we got one now, and he a realtor. We've been dealing with him for 2 years, and now his house is just about done. He's scheduled to close in about a week and a half. That was a process. So, we went through about 3 credit reports over that 2 years of, okay, you're definitely not ready. Do this, this, and this.
Okay.
Had some roadblocks, but got there. Okay, you're a lot better than what you were. Here's the next things to do. And then, went through those steps and be able to get there. So when it depends on really where you are, everybody is truly different.
Mm-hmm.
There are some people who almost really need some professional credit repair help. And then there's some is like, why pay somebody to do this when it's going to take a couple $100 to clean this up and clean that up sometimes? We have to really look at what's there to determine what level of professional help. Now, we don't have any specific credit repair companies that we refer people or anything to. Just years, so many have come and gone, and it's hard to get reliability in it. Just, like you did with a coworker, if you know somebody personally experiencing it and have those references to be able to do it. We approach with it a lot, but again, they come and go, so we don't stay consistent.
We're more proponents of educating people about their credit. Not so much just about cleaning it up and some of this stuff. I'm not saying it comes back, but you get back in the same boat again. We're more about educating you about your credit. It's not simply just cleaning credit repair. So we're saying that there are things we can probably tell you that you may need to do. And it may not be to where you need to go and pay somebody, a certain amount of money. You may be able to put that money into taking care of it yourself, because honestly, I've seen people, and I don't know how your coworker is, but I've seen other people, they get on the hook for, 50, 60, 70, maybe even $100 a month for credit repair, and nothing happens, It could really be just things that you may be able to tackle yourself over a certain time frame and get it done.
Okay.
Is you want to have it assessed by is what we do, so we know what credit is going to take to get you approved for a loan. So we're not just giving you a cookie cut to get your credit scores up. Is to get your credit profile strong enough to get approved for a home loan. Specifically. So, we'll look at that. Sometimes it could be to add a credit card. People sometimes look crazy. You want me to add a debt? Not so much as a debt, but something that's going to lift your credit score up. And you can probably use that new credit card to pay off a couple of these things, which is going to also boost you. So we look at all of those things to get you on the right path. Usually professional credit help comes in if there's just within the last 12 months, a bunch of 30, 60, 90-day lates that if you have a legal reason to probably get rid of those, maybe a professional can help you, with those, or you're using them professionally to help you negotiate and settle a debt. you know,
Mhm.
but again, we have to look at what's the cost of it all to get you where you need to be versus a professional. Your best professionals are going to want 1,000 or more, you know, beyond.
Mhm.
But sometimes we'll look at credit and it's $300 to $1,000 worth of stuff to fix, and it'll be fixed for good, and you can do it yourself and not have to worry about somebody else doing it. It's
Yeah.
better spent for you to just do it. Those projections, when we pull credit, those scenario projectors, they're pretty spot on.
Mhm.
When they tell you, because it can predict what you do with that. It can even predict that we put in, if you add you know, a credit card with a certain limit and things like that, it can tell us what your score may do in immediately, 1 month, 2 months, 6 months, a year.
Yeah.
You know,
Mhm.
kind of projections. So we just tell people, whenever you think you're ready to plan, come on in and take a look down. Don't wait till your month away, lease about to end. You got to be out in 29 days, then start this.
Yeah.
You know, it's gonna be a problem. You know, but
Right.
earlier the better.
Yes.
And
Okay.
I agree with you on I'm glad you talked about that Credit Karma, because I recently, like last week, had a panic attack because it sent me, like, I was close to 700, and then like the same day it showed me something 200 points less.
Wow.
And I'm like, I've been paying everything on. I mean, I was panicking. Matt could tell you I was panicking. I was like, guys, I was so close. And then I do have experience. So I checked Experian, and it wasn't true. It wasn't true at all.
Wow.
And I don't
Yeah,
Wow.
I don't know if it was a glitch. So y'all were very right about that. So I stopped checking it because
Plus, TransUnion is building their own platform, so
Mhm.
they won't even reporting to Credit Karma pretty soon.
yeah.
Yeah.
Wow.
Yeah, so I think they're only going to have Equifax left,
Okay.
and
Yeah.
which is useless to just have them for one credit score.
Right.
Right.
So yeah.
Yeah,
So
they may go kaputs, but you know, they were a marketing giant. So if you're on Credit Karma and you start getting random calls and random mail and offers and things like that, that's what they come into play on.
that's why I do that. Yeah. Yes, yes, yes.
Anybody else? Thanks, Ms. Rhonda. We look forward to speaking with you.
All right.
And just a shout out
Oh,
to Miss
yeah.
Rhonda. Miss Rhonda is one of the best leasing agents in all of Houston area. Okay.
Okay.
Top
Oh,
10.
oh, she down in H-Town.
Yes.
H-Town in the building.
Top
We'll
consistent
be passing through soon. We got to go to Texas City down there.
Yep.
Oh, okay.
Yeah.
I know Shalita wasn't able to be on the call today, Ashley, because she had to go to a Bible study virtually. So she missed
I
it.
told her to go ahead and put Jesus first. So
Yeah.
I did
Gonna send you all the questions though.
I did record this call, so just in case, so some people couldn't make it, so I'm able to send that out to you guys, and I'll send it out to you guys too, the Fosters, and so y'all can have that to send to folks. But I did record it,
Oh,
so if
good.
y'all missed
Thanks.
something or your phone cut out, I know some people I can see them pop in and out, probably their internet, so I don't miss a thing. But yeah, so just reach out and I will send that. It takes probably it'll take all night because this was a good call. So it'll take all night to download, but I do have it. But yeah.
All right.
Well, guys, I just wanted to thank you guys so much. Me and Matthew will be hitting y'all up next week to work on our goals.
Okay.
And so you guys can tell us what we need to do, or you might give us the green light or pause. I'm fine with either answer. But most definitely. And everyone else, I will be in contact with you guys just to get y'all to our 2021 goals. But that's all I have to say. And thank you guys. And I'll be sending out the Foster's information as well.
Okay.
Right.
Thank you, guys.
Thank you, guys.
Y'all have a good
evening.
night.
Bye.
All right.
Bye.
Bye.